I need to tell you about my coworker. Let's call him Kevin. Kevin works hard. Kevin is smart. Kevin just got offered a raise, a real raise, going from $65,000 a year to $75,000. $10,000 more dollars a year. And Kevin turned it down. Kevin turned down $10,000 because he was afraid that the raise would push him into a higher tax bracket. And that higher bracket would end up costing him money. He would earn more and take home less. That was his reasoning. That is what Kevin believed. Kevin is not alone. This is one of the most widespread financial myths in America. Millions of people believe it. And today, with Max's help, we are going to destroy this myth completely. Because Kevin left $10,000 on the table. And I will not let that happen to you. Before we bust this myth, let me make sure we're all starting from the same place. Here is exactly what Kevin believed, and what a shocking number of adults in this country believe about taxes. The belief is, tax brackets are like light switches. The moment your income crosses a threshold, the government flips a switch and suddenly everything you earn, every dollar from $1, gets taxed at the higher rate. So theoretically, earning one more dollar could cost you thousands. Kevin ran this calculation, got scared, and said no to the raise. This is completely, demonstrably, 100% incorrect. The US tax system does not work this way. It has never worked this way. And the fact that millions of people believe it does is, in my opinion, a genuine educational crisis. Let me show you how it actually works. Tax brackets in the US are marginal. Marginal means each bracket only applies to the income that falls within it, not your entire income, not your first dollar, just the slice that lands in that range. For 2025, as a single filer, the first $11,925 of your taxable income is taxed at 10%. Not your whole income, just that first slice. Every dollar from 0 to 11,925, 10 cents per dollar to the government. The next slice, from 11,926 up to 48,475, gets taxed at 12%. Again, only the income in that range. If you make $48,000 a year, you're paying 10% on the first slice and 12% on the second slice. That's it, not 12% on everything. The next bracket, 22%, kicks in on income between 48,476 and 103,350. And here's the critical point. If your income is in this range, you are in the 22% bracket. But you are not paying 22% on your whole salary. You're paying 10% on the first slice, 12% on the second, and 22% only on the portion that lands in this third band. Let's make this real with Kevin's numbers. Kevin earns $65,000. After the standard deduction for 2025, $14,600 for a single filer, his taxable income is about $50,400. Bracket 1, $11,925 at 10% equals $1,193. Bracket 2, $36,550 at 12% equals $4,386. Bracket 3, $1,925 at 22% equals $423. Total federal tax, $6,002. Effective rate, approximately 12%. Kevin's effective tax rate is about 12%, not 22%. The 22% bracket only applied to less than $2,000 of his income. He is in the 22% bracket the same way I'm in Manhattan if I'm standing 1 foot past the city limit. Technically true, practically almost irrelevant. Now let's do the math Kevin was afraid to do. Kevin gets the raise. He now earns $75,000. After the standard deduction, taxable income of roughly $60,400. His tax bill goes up by about $2,200. Yes, he pays more tax. But he also earned $10,000 more dollars. So his take-home pay increases by roughly $7,800. Kevin turned down $7,800 of extra take-home pay because he did the math wrong. And here's the important universal truth here. A marginal tax system means earning more always puts more money in your pocket. Always. There is no income level where earning one more dollar makes you poorer after tax. That scenario literally cannot happen in the US tax system. If someone tells you it can, they have fundamentally misunderstood how taxes work. So, to Kevin, I love you. You're a hard worker. Please call your manager back. You deserve that raise. Now that you understand how brackets work, I want to introduce two terms that will completely change how you think about taxes. Your marginal tax rate is the rate that applies to your last dollar of income. If you're a single filer earning $50,000, you're in the 22% bracket. 22% is your marginal rate. Your effective tax rate is the actual percentage of your total income that you pay in taxes. It accounts for the fact that your first $10,000 was taxed at 10%, the next $36,000 at 12%, and only the last bit at 22%. It's the blended, averaged, real rate. For Kevin, at $65,000, the effective rate was about 12%. When you read news headlines saying the top income tax rate is 37%, that's the marginal rate. Billionaires who hit that bracket are not paying 37% of their income to the government. They're paying 37% on income above $731,000. On everything below that, they pay the same lower rates you do. The marginal rate is useful for planning. It tells you the tax cost of earning one more dollar. The effective rate is useful for comparison. It tells you what you're actually handing over. Know both. Use both. Never confuse them again. Now I want to acknowledge something, because I can feel some of you thinking, Max, this is basic. Everyone knows this. I'm telling you, they don't. A survey by the Tax Foundation found that a majority of Americans believe moving into a higher tax bracket means all of their income gets taxed at the higher rate. Majority, not a fringe group, most people. I've heard this myth from accountants. I've heard it from people with MBAs. I've heard it from someone who works in HR at a financial services company, who was literally in charge of salary decisions. The myth spreads because almost no one sits down and explains it the way we just did. And the consequences are real. Kevin turned down a raise. Other people avoid overtime. Others decline bonuses. Others structure their freelance income to stay under a threshold they think is dangerous. All of them are leaving money on the table because of a myth that takes exactly 12 minutes to fully understand. That's why this video exists. Okay, now that we've destroyed the myth, let's talk about what you can actually do to legally reduce your tax bill. Strategy 1. Max out your pre-tax retirement accounts. Every dollar you contribute to a traditional 401k or traditional IRA reduces your taxable income before a single bracket applies. In 2025, you can contribute up to $23,500 to a 401k. If you're in the 22% bracket, that's potentially $5,170 in taxes you don't pay this year. Gone, legal, yours to keep, just deferred. Strategy 2. Understand what deductions actually do. A deduction doesn't eliminate your tax. It reduces your taxable income, which means you save your marginal rate on every dollar deducted. If you're in the 22% bracket and you have a $1,000 deductible expense, you save $220 in taxes. Not $1,000, $220. Strategy 3. Time your income. This one is mostly for freelancers and self-employed people, but it's powerful. If you know you'll be in a significantly lower bracket next year, consider deferring income into the lower bracket year. Conversely, if you expect to be in a higher bracket next year, accelerate income into this year's lower rate. Tax brackets are not just about what you earn, they're about when you recognize it. None of these strategies are loopholes. None of them are shady. They are built into the tax code specifically to incentivize retirement savings, home ownership, charitable giving, and business investment. The people who pay the lowest effective tax rates aren't cheating. They're using every legal tool available. Now you know what those tools are. I want to do something a little different in this section. Instead of giving you more information, I want to give you a job. Think right now about someone in your life who might believe the tax bracket myth. A parent, a sibling, a coworker, a friend who turned down a bonus or avoided overtime because of this exact misunderstanding. Here's the thing about this myth. It doesn't just affect the person who believes it. When Kevin turned down his raise, his manager probably thought he lacked ambition. His opportunity for future raises may have been affected. His retirement savings gap widened because $10,000 a year for 30 years invested is a life-changing amount of money. One misunderstood concept, decades of downstream consequences. Send this video to your Kevin. Text it to your sibling who just got a job offer and is hesitating because of the bracket. Share it with your parents who have been avoiding overtime for 20 years. This is the kind of information that actually changes financial decisions. And financial decisions change lives. Here's what I need you to remember from today. 1. Tax brackets are marginal. Each rate only applies to the income in its range, not your whole salary. 2. Earning more always puts more money in your pocket after tax. Always. There is no raise that makes you poorer. 3. Your effective tax rate is almost certainly lower than your marginal rate, and it's the number that actually describes your tax situation. And if you want to actually pay less tax, max your retirement contributions, understand what deductions due to your taxable income, and time your income strategically when possible, that's the whole playbook. Next week, we're talking about the one investing mistake that's quietly costing millennials $200,000 in lifetime wealth, and nobody knows they're making it. Subscribe so you don't miss it. Share this one with your Kevin. And please, don't turn down raises. Don't be like Kevin.